Right now, the IRS is quietly watching 5 specific areas of your retirement income. And if you get even one of them wrong, you could be looking at penalties, surprise tax bills, and the kind of stress that no retiree should ever have to deal with. Here is what most people do not realize. The moment you stop receiving a paycheck, the entire tax system that protected you for decades disappears overnight. Your employer was handling your withholding, your reporting, your compliance, all of it, automatically, without you ever having to think about it. The day you retire, every single one of those responsibilities transfers directly to you, and the IRS does not send you a welcome packet explaining what just changed. They just expect you to figure it out. And when you do not, the notices start showing up in your mailbox. Today, I am going to walk you through all 5 areas where the IRS changes how it watches your money the moment you retire. These are not abstract concepts. Each one has a specific form, a specific deadline, and a specific penalty if you get it wrong. And every single one of them is something that an employee never has to think about because their employer handles it for them. This is for educational purposes only and is not tax or financial advice. Always consult a qualified tax professional before making any decisions about your specific situation. The first thing that changes the moment you retire is withholding. When you were an employee, your employer withheld federal income tax from every paycheck. You filled out a W-4 when you started the job, you chose your withholding, and for the rest of your career, the system ran on autopilot. Taxes came out before the money hit your account. Most employees never owed a large bill at filing time because withholding had already covered it throughout the year. The moment you retire, that automatic system vanishes completely. Your income in retirement comes from multiple sources that do not have automatic withholding the way a paycheck does. Social Security has voluntary withholding, but only if you set it up yourself. IRA and 401k distributions have optional withholding at rates you choose. Pension income has a withholding form called W-4P that you can fill out, but most retirees never do. And then there is investment income from dividends and capital gains, rental income and interest income, none of which have any withholding at all. The result is that most retirees arrive at their first retirement tax season with a significant underpayment they did not see coming. The IRS expects you to pay taxes on income as you receive it throughout the year, not in one lump sum in April. If you underpay throughout the year by more than $1,000, you may owe an underpayment penalty on top of the tax itself. The underpayment penalty rate for the first quarter of 2026 is 7%, and it dropped to 6% for the second quarter. These rates change quarterly based on the federal short-term rate, and they compound on the amount you should have paid but did not. Now let me give you the IRS safe harbor rule because this is the specific number that determines whether you owe a penalty or not. The IRS will not charge an underpayment penalty if you paid at least 90% of your current year tax liability through withholding and estimated payments combined, or if you paid 100% of your prior year tax liability. If your prior year adjusted gross income was above $150,000, the safe harbor increases to 110% of your prior year liability. This means that in the first year of retirement, the easiest way to avoid an underpayment penalty is to look at your prior year tax return, find line 24, which shows your total tax, and make sure your combined withholding and estimated payments for the current year equal at least that amount. You may still owe some tax at filing time if your income changed significantly, but you will not owe the underpayment penalty. The fix is straightforward, but almost no retiree implements it automatically. For Social Security income, file Form W-4V with the Social Security Administration to request federal withholding. The options are 7%, 10%, 12%, or 22% of your monthly benefit. For pension income, file Form W-4P with your pension administrator to set your withholding. For IRA distributions, request withholding when you take each distribution. And if your income is irregular or comes from sources without withholding available, make quarterly estimated tax payments using Form 1040 ES. The estimated tax deadlines for 2026 are April 15th, June 15th, September 15th, and January 15th of 2027. Missing a quarter triggers a separate underpayment calculation for that specific quarter. The IRS does not average your payments across the year. If you pay everything in the last quarter, you still owe penalties for the first 3 quarters, even if the total annual payment is correct. There is one more withholding situation specific to pension income that catches retirees who worked in government or who have defined benefit plans. Many pension plans include a portion of after-tax employee contributions. If you contributed after-tax money to your pension during your working years, that portion of each payment is a return of your own money and is not taxable. The IRS calls this the simplified method for calculating the exclusion ratio, and you can find the worksheet in IRS Publication 575. The IRS specifically watches whether retirees with pensions that include after-tax contributions are correctly calculating the non-taxable portion. If you are reporting the entire payment as taxable, you are overpaying. If you are reporting more as non-taxable than the calculation supports, the IRS will flag it. Many retirees and even some tax preparers are not aware of this cost recovery exclusion. The second thing that changes is how the IRS monitors your Social Security income. When you begin receiving Social Security, you receive Form SSA 1099 each January, showing your total benefit for the prior year. This form goes to both you and the IRS. The IRS already knows exactly how much Social Security you received before you even file. What the IRS is watching specifically is whether you correctly calculated the taxable portion of your benefits and reported it accurately on line 6B of Form 1040. The calculation uses what is called combined income, which is your adjusted gross income plus non-taxable interest plus 50% of your Social Security benefits. If that number exceeds $25,000 for a single filer or $32,000 for a married couple filing jointly, a portion of your Social Security becomes taxable. Above $34,000 for single filers or $44,000 for joint filers, up to 85% of your Social Security may be taxable. These thresholds have not been adjusted for inflation since they were created, which means more and more retirees are crossing them every year. The mistake most retirees make is assuming Social Security is tax-free because they paid into it for decades. It is not tax-free if your income is above the threshold, and the IRS cross-references the SSA 1099 it receives from the Social Security Administration with what you report on your Form 1040. If those numbers do not match, or if the taxable portion calculation appears incorrect, the IRS flags it. There is another Social Security reporting issue that specifically affects people who retire mid-year. If you retire in June and collect Social Security starting in July, you will have 6 months of earned income and 6 months of Social Security. The Social Security Administration applies an earnings test if you have not yet reached your full retirement age, which is 67 for people born in 1960 or later. Under the earnings test in 2026, if you earn more than $24,480 in the year before reaching full retirement age, the SSA withholds $1 in benefits for every $2 earned above that limit. This is not an IRS rule, but it creates a tax reporting complication. If the SSA withholds some of your benefits due to excess earnings, the amount you actually received may differ from certain figures on your SSA 1099. When reporting Social Security income, you use the amount in Box 5 of the SSA 1099, which is the net benefit received after any SSA withholding. If you get confused about which number to use and report the wrong figure, the IRS will send a notice. For retirees who retire mid-year in the year they first claim Social Security, there is also a special first-year rule that allows the SSA to use a monthly rather than annual earnings test. This can significantly increase how much you are allowed to earn in the partial year of retirement without losing benefits. If this applies to you, contact the Social Security Administration directly about the first-year rule and how it affects your benefit calculation. Let me put a real dollar amount on the withholding problem so it is not abstract. Imagine a retiree who stops working in January 2026. His retirement income for the year is $36,000 in Social Security, $24,000 from a pension, and $18,000 in IRA withdrawals. His total income is $78,000. When he was working, his employer withheld roughly $14,000 in federal income tax throughout the year. But in retirement, he set up no withholding on his Social Security. His pension withheld only $2,000 at the default rate. He took his IRA withdrawals with no withholding. When he files in April, his federal tax liability is approximately $10,500 based on his income and filing status. He has only had $2,000 withheld all year. He owes $8,500 at filing, plus an underpayment penalty because he did not make quarterly estimated payments. The penalty itself is not enormous, but combined with the unexpected $8,500 bill, it is a serious shock for someone on a fixed income. He made no errors. He broke no rules. He simply did not set up the replacement withholding system that his employer had been running automatically for 3 decades. The third thing that changes is 1099-R reporting from retirement accounts. Every distribution you take from a traditional IRA, a 401k, a 403b, or a pension generates a Form 1099-R that goes to both you and the IRS. The IRS receives your 1099-R forms before you file your return and compares what those forms say to what you reported. The specific things the IRS watches on 1099-R forms include whether you correctly identified the taxable and non-taxable portions of each distribution, whether you correctly applied the exception to the 10% early withdrawal penalty if applicable, and whether required minimum distributions have begun and are being taken correctly. The distribution code in Box 7 of the 1099-R tells the IRS a great deal about the nature of the distribution. Code 1 means early distribution without exception and flags the 10% penalty automatically. Code 2 means early distribution with exception and requires you to explain the exception. Code 7 means normal distribution after age 59 and a half. If your custodian assigns the wrong code, which happens more often than you would think, the IRS will apply the wrong tax treatment and send you a notice. There is one specific 1099-R situation that creates major problems in the first year of retirement for people with 401k plans. When you separate from a job and roll over a 401k balance to an IRA, the custodian issues a Form 1099-R for the full rollover amount. Box 1 shows the gross distribution, and Box 2A should show 0 as the taxable amount if it was a direct rollover. But if the code in Box 7 is wrong, or if the rollover was not done as a direct trustee-to-trustee transfer, the IRS may treat the entire amount as a taxable distribution. A retiree who rolls over $300,000 from a 401k to an IRA and receives a 1099-R with the wrong code could receive a notice proposing tax on $300,000 of phantom income. The fix is to review every 1099-R you receive in your first year of retirement, line by line before filing. If anything looks wrong, call the custodian and get a corrected form before you file. Required minimum distributions create a separate tracking issue. Beginning at age 73 for retirees born between 1951 and 1959, and at age 75 for those born in 1960 or later under the Secure 2.0 Act, the IRS requires a minimum annual withdrawal from traditional retirement accounts. The custodian reports distributions on Form 1099-R but does not verify whether the amount taken met the RMD requirement. That verification is entirely the account owner's responsibility. If the IRS believes you took less than required, it can assess a 25% excise tax on the shortfall. Under the Secure 2.0 Act, that penalty drops to 10% if you correct it within 2 years using Form 5329. But even 10% of a large shortfall is a significant amount of money that is entirely avoidable. The fourth thing that changes is capital gains reporting. When most people are working, their investment income is relatively modest compared to their salary. In retirement, this changes dramatically for 2 reasons. First, many retirees begin drawing down investment portfolios to fund living expenses, generating capital gains from sales they would not have made while working. Second, retirees often have more flexibility to time their income, which means they should be managing capital gains strategically but frequently are not. The IRS watches Form 1099-B and Form 1099-DIV from brokers and mutual funds. These forms go to both you and the IRS. When you sell an investment, the 1099-B reports the proceeds and often the cost basis. If the cost basis reported to the IRS differs from what you report on your return, the IRS flags it automatically. The most common problem retirees encounter is with inherited investments and old accounts. A stock held for 20 or 30 years may have a cost basis that is completely wrong in your broker's records because it was purchased before electronic tracking was standard, it was inherited, or it was transferred between brokers without the basis information carrying over. If you sell that position and your broker reports an incorrect cost basis to the IRS, you will receive a CP 2000 notice proposing additional tax based on the discrepancy. The fix is simple but must be done before the sale. Verify the cost basis your broker has on file for any long-held investment. If it is wrong, correct it before you sell. If you inherited the investment, the basis is generally the fair market value on the date of the original owner's death under IRC Section 1014. That stepped-up basis eliminates the gain that accrued during the prior owner's lifetime and is one of the most valuable provisions available to retirees receiving inherited assets. The second capital gains issue specific to retirement is the interaction between long-term capital gains and the IRMA A surcharge for Medicare. In 2026, the IRMA A first tier begins at $109,000 of modified adjusted gross income for single filers and $218,000 for married couples filing jointly. Long-term capital gains, even those taxed at the 0% rate, still count toward your modified adjusted gross income for IRMA purposes. A retiree who harvests capital gains in a low-income year, thinking they will pay 0% tax, may trigger a Medicare surcharge 2 years later that completely wipes out the tax savings. The IRS and Medicare use the same income numbers independently, and it is the retiree who fails to model the interaction in advance who ends up paying more than necessary. The fifth thing that changes is self-employment and side income reporting. Retirement for many people is not a complete stop. It is a transition. Consulting work, freelance projects, part-time jobs, rental income, selling items online, all of these continue or begin in retirement, and they all carry IRS obligations that are different from what a traditional employee faces. The moment your net self-employment income reaches $400 in a year, you owe self-employment tax at 15.3% on 92.35% of that income, on top of ordinary income tax. You must also file Schedule SE with your Form 1040. Many retirees who pick up consulting work after retiring do not realize they are now subject to self-employment tax because they have never been self-employed before. An employee has FICA taxes split with their employer. A retired consultant pays both the employee and employer share directly. The IRS cross-references Form 1099 NEC from clients who pay a contractor more than the reporting threshold in a year. If a former employer pays you for consulting work and files a 1099 NEC with the IRS expects to see Schedule C and Schedule SE on your return. If you forget to include them, the IRS will send a CP 2000 notice. There is a significant tax advantage available to self-employed retirees that most miss entirely. If you are self-employed in retirement and you pay for your own health insurance, including Medicare premiums, you may be able to deduct 100% of those premiums as an above-the-line deduction on Schedule 1 of Form 1040. This deduction reduces your adjusted gross income directly, which in turn can reduce the amount of your Social Security that is taxable and may keep you below the RMDs threshold for Medicare. The deduction is available for premiums paid for yourself, your spouse, and your dependents. It cannot exceed your net self-employment income for the year, and it cannot be claimed for any month you were eligible for employer-sponsored health insurance through a spouse's employer. For a retiree doing consulting work with $30,000 in self-employment income and paying significant Medicare premiums and supplemental insurance costs, this single deduction can reduce their AGI dramatically and potentially determine whether their Social Security is taxed at 85% or a much lower rate. If you sell items online through platforms like eBay, Etsy, or Facebook Marketplace, you need to know about Form 1099-K. In 2026, the reporting threshold for third-party settlement organizations is $20,000 in aggregate payments and more than 200 transactions. If you exceed that threshold, you will receive a 1099-K, and the IRS receives one too. Many retirees who downsize and sell personal items assume those sales are not taxable. For items sold for less than you paid, there is generally no taxable gain, but if you sell something for more than your original cost, that is a capital gain. And if the IRS receives a 1099-K and your return does not account for those payments, you will receive a notice. Rental income is another area the IRS watches closely in retirement. Rental income is ordinary income reported on Schedule E of Form 1040. If you have been writing off depreciation on a rental property for years, the IRS tracks those deductions. When you eventually sell the property, the accumulated depreciation creates a separate tax liability called depreciation recapture, taxed at up to 25%. This exists in addition to any capital gains tax on the price appreciation. Many retirees who sell rental property are shocked by this bill because nobody explained that depreciation taken over 15 or 20 years would come back as a tax liability at sale. One final point that applies to higher income retirees. If your modified adjusted gross income exceeds $200,000 as a single filer or $250,000 as a married couple filing jointly, your net investment income is subject to an additional 3.8% net investment income tax. This applies to interest, dividends, capital gains, rental income, and passive business income. It is calculated on Form 8960, and any error in the calculation will result in a notice. For a retiree with substantial investment portfolio income on top of Social Security and pension income, this additional tax can amount to thousands of dollars that do not appear on a standard tax calculator. There is one more dimension that connects all 5 of these areas that is worth understanding. The IRS is not the only agency watching your retirement income. Medicare uses your adjusted gross income from 2 years prior to set your Part B premium through the RMDs surcharge. Social Security uses your annual income to determine what percentage of your benefit is taxable. Medicaid uses your income and asset history to determine long-term care eligibility. These agencies all draw from the same source, your tax return. Every mistake in retirement tax reporting creates downstream consequences, not just with the IRS, but potentially with Medicare premiums 2 years later and with any means-tested benefit you may need access to in the future. The common thread across all 5 of these areas is the same. As an employee, your employer was your tax compliance system. They withheld, they reported, they filed. The moment you retire, you become your own employer for tax purposes. The obligations do not disappear, they transfer to you, and the IRS expects you to handle them with the same accuracy your employer did, starting with your very first month of retirement income. Here is one practical tip that saves most first-year retirees significant stress. In October or November of your first retirement year, before you have filed anything, sit down and estimate your total tax liability. List every income source. Run it through the Social Security taxation formula. Apply your filing status and deductions. Get a rough estimate of your total federal tax liability. Then total up everything you have actually had withheld or paid in estimated taxes. If the tax owed is significantly larger than what you have paid, you still have time to increase withholding or make an additional estimated payment before year end. You cannot retroactively fix prior quarters, but you can reduce the final quarter shortfall and walk into April knowing exactly what is coming rather than being blindsided. The transition from employee to retiree is not just a lifestyle change, it is a complete tax system change. And the sooner you understand which 5 things the IRS is now watching in your financial life, the sooner you can set up the systems that make retirement taxes as automatic and painless as employment taxes used to be. For more retirement tax strategies, tips, and the kind of information that can save you real money, make sure to stay connected with Retirement Wealth Watch.